Hey guys, how are y'all tonight?
Pretty good. How are you?
I'm okay. I am downstairs because Monday night, the connection to in my office upstairs just failed completely. So I'm downstairs, but I had a techie guru here yesterday, and we're going to solve this by next week, I hope. So the catch is I'm right here, but the dogs are right there. And they were really good all during my 4:30 class. I have no idea, so let me just apologize in advance. I've shut the drapery so they can't see the squirrels, no matter what. But, but down here, I had a great connection. Up there, I mean, I couldn't even sign on to Blackboard. So I had a techie guru come and we explored all the options, including running cable through the wall. Yeah. Or running it up one side into the attic and across. I vetoed both of those. I can see a bad. Plus, if you run it through the attic, good Lord. I mean, who knows what squirrels and chipmunks are up there chewing on God knows what. I mean, this is not a good idea. I could see bad things happening here. So we're going with some sort of mesh thing that is coming tomorrow, and he's coming to install it. And hopefully I'll be back in my office, which I'll be much happier. But at any rate,
I'm sure the dogs matter.
Yeah, I know. Sure if they bark, they're cute and they're right here. And I haven't had dinner yet, so who knows?
Oh yeah, they might be barking then.
Yeah, they might. They don't. I don't know. I gave them some treats to kind of,
be good. Be good.
And they're being really good. They can't see out. That's the thing. I think that's what's doing. I've shut the front door. They can't see out the glass, and they can't see out the back. So I have high hopes. Okay, how did we all do with our cases?
I thought it was pretty interesting. I liked mine.
Good.
Yeah.
I think, well, financial health will kind of get you launched easy because it's just a ratio type case, and I'm going to talk about it. And Jones Electric, we'll talk about that one when we do that. Here's the plan. I'm going to talk about financial health. Then group one is going to talk about Jones Electric, and then I'll talk some about it. And then we'll take a little brief break. I might feed them if they start to move. And then I'm going to talk about weighted average cost of capital, because the three cases next week, Marriott, Ameritrade, and your individual case, Tire City is financial, is this stuff. So you have an individual case next week, and we have two, and they're both weighted average cost of capital. So I need to talk about that some. Okay. Right. Let's see if I can figure out how to share my screen. I'm on. No, that isn't what I want. That's what I want. Financial health. There we go. That's the one I want from the beginning. And I want to put this down, and I want to move this little guy down here. Okay, from the beginning. Okay. Here's what they kind of put at the beginning of this thing. That's where we analyze. I mean, anytime you're going to go forward, you need to figure out where am I and where do I want to go and what do I need to do to get there. And they go through the steps and talk about it. This is where we're kind of looking at here, assessing external financials needs and how in the world are you going to get it? That's the key thing. Now, here were their data that they gave us. And as you can see, their sales were increasing great. They were increasing like 20%. Net income went up huge in 2008.
Is Mom, is it ready?
Was that for me?
No, I'm sorry. I was asking my mom if dinner was ready. I apologize.
Yeah. You can eat during class.
I thought I was muted.
That's okay. You can eat during class. I have a Coke here. It's okay.
I'm sorry.
Hey, you know what? Let me tell y'all. I read this thing this week from Harvard, but it was about case studies online. But it really wasn't so much about case studies. It was about teaching online. And what it was saying is you've just got to realize everybody's at home. Their dog and cat's going to come in. The phone's going to ring. The door, stuff's going to happen. That's what, it is what it is. It's okay. It's not a problem. Okay. There we go. Their sales went up like 20-something%. I mean, it really did great. Their net income jumped big time. Look down here. They got rid of some of their long-term senior debt, but they issued a lot of subordinated convertible debt. Now, here's their sales growth. Look at that. Year to year, their sales growth is really good. Profit margin, that was good, but it's okay. Okay. Now, we're going to look through the profitability, and I'm going to pull up the actual spreadsheet here in a minute. You see this little thing that says TN? That's what the teaching note got. And I never could get the number that they got, so I don't know what they were doing. The return on sales got better. Went from 3.4 to 5.7. The return on equity, my gosh, more than doubled. That's awesome. Their return on capital just about doubled. That is terrific. Cost of goods sold, it went up a little bit. That's not good. Gross profit went down. That's not so good. R&D, selling and general admin went down. That's a good thing. Operating income as a percent of sales, that's good. Their average tax rate went down. That's good. That's the one that's improving. It's a function of their improving profit margin and more leverage. Now remember, you can drive ROE up. I just talked about this in the other class. You can drive ROE up by adding debt and using the money to buy back equity. Think of it this way. I own the company. It's worth $100, and we made $20 last year. And it's 100% equity, $100 of equity. And I decide to borrow $50 and buy out those $50 of shares. So now the company is $50 equity, $50 debt. Same company, same 20%, $20 in income. But now return on equity is 20 over 50 instead of 20 over 100. You can drive up return on equity by issuing debt. Now, let's look at Dupont Identity. I just talked about this in my last lecture too. Their profit margin improved and they increased their leverage. That's what drove their ROE up. Total asset turnover stayed pretty much where it was. Looking at their asset management, their sales to total assets went down a little bit. Their collection period went down, so that's a good thing. Inventory turns went up, so they're turning their inventory faster. Again, I'm thinking they're using cost of goods sold instead of sales here. That means the teaching note gave me that number, and I couldn't get it. Days in inventory, that's good. They have less days in inventory. Sales as a percentage of net profit and equipment, that's not as good. Note their collection period. Remember from 338, the conversion process, theirs is 250 days. Collection period plus days in inventory, it's 250 days. So that's pretty long. Leverage. Assets to equity got better. Liabilities as a percentage went up because they issued that subordinated debt. Debt as a percentage of total capital went up. Times interest earned went up too, though. So that's a good thing because they're easily able to cover the interest. And accounts payable as a percentage of cost of goods sold. I just left it. Both of their liquidity ratios went down. They're still above 1 in both cases, but they both went down. Here's where you put it all together. Looking at that, you can understand why you might need something like the Dupont Identity to figure out. Because the green ones are better, the red ones are worse. So it's kind of, where are we? You know, I used a textbook years ago, and I don't have it, that had like a flow chart. And it started with the Dupont Identity. And it kind of said, okay, if your problem is in your profit margin, come down these legs. These are the things you need to look at. That's what it's supposed to do, is point out to you where you should be looking for your problems. Now, I do not anticipate anybody got this. I wouldn't have gotten it, but I thought it was kind of interesting. So I said, just go on and give it a try. They've got these 5 unidentified industries, and they want you to use the balance sheet and their ratios to figure out which ones are which. And there's what you got. Electric utility, discount merchandiser, upscale apparel, Japanese auto, and automated test equipment. Here's how they did it. It's really kind of interesting. There, this one is, the A is an electric utility. Here's why they say that. Their assets are huge, and it's largely plant and equipment. Their collection period is only 52 days. They have a high return on sales. Their inventory is low because it's fuel. B is a discount general merchandise retailer. High sales to total assets, low inventory. High sales to net plant, low return. Discount merchandiser is going to have a low return. Upscale apparel. They actually admit they found this one by elimination. The long collection period is because they have their own company-owned card. Think Talbot's, ladies, J. Jill. High sales to net plant is because they lease. Japanese auto, long collection because the inventory is held at the dealer level. And the last one, automated test equipment, high inventory level, because it takes them so long to build the thing. It takes them a long time to get it built. Didn't you think that was kind of interesting? Not so much? Okay, let me find the actual spreadsheet for this. That's not it. Here it is, financial health. That's the one I want. Okay. There you can see the sales growth from 2004 to 2008 was 20%. That's pretty good. And that's how I got that. There's where all those numbers came from. Look at this. Their return on equity more than doubled. I mean, that's really pretty good. Anybody have trouble with any of these ratios? Pretty much okay with it? Okay, some of the questions, I will go back over here. What are 2 or 3 most important questions you'd ask? Well, you could project their sales and profitability for the next years. How are they going to fund it if they keep growing? And how are you going to defend that type of sales forecast? Because look back at their numbers. That's a pretty hefty growth. I mean, they're growing pretty rapidly. That may be an issue in terms of supporting that type of growth. Okay, questions about it? Okay. Let's look at Jones Electric. Stephen, Heather, Elizabeth, who's going to present? Are you all going to do it? Are you going to share it? Or?
Well, we've actually got a problem. Stephen was working with us and he's not in class and we don't have all of our information together. Like I've got the spreadsheet, but we don't have a presentation put together.
I wonder where he is.
Yeah, I'm not sure. We divided up the questions amongst each other. So he was working on 5, 6, and 7, and we haven't gotten his answers. He mentioned that his grandfather was in the hospital in ICU with COVID, and that's why he's kind of been hard to get in touch with this week. I'm not really sure. I can go over what we've got.
Why don't you go on and go over what you've got, and then I'll go on and talk about it. Because this one was the first one, and I'm not going to be very when you see Harvard's solution to this, everything they give you, I can assure you, you're just going to go, I would never have thought of that, because you wouldn't have. I mean, but now you got to realize this is the professor who wrote the case is writing the solution. And I don't want you to feel, I want you to see it all, but I don't want you to feel like I think you should have thought of all that.
Right.
Does that make sense?
It's a lot more. It's a lot of work. It's a lot more than what we anticipated. So I don't feel like we're really properly prepared for it either. We didn't realize what we're.
And that's okay. This is the first one, and that's okay. I understand.
We're trying to get used to it. So we're going to do better next time.
Believe me, I totally understand. And like I said, I was looking over the solution this afternoon, and I thought, who would have thought of that? Who would have thought to ask to do that? I mean, I've got all these little, because see, I get it all. I get the teaching notes. I get everything. I get the whole solution. And so I wanted to be sure you all understood. I don't, and that's true on any case. I don't ever expect you to have thought of everything that they think of. That might have made these a month-long case instead
Right.
of a week-long case. Like, oh my gosh. But I want you to see what all they put in the solution so you can say, you know what? Yeah, that makes sense. Let's do it. Okay, you and Elizabeth go on and do your thing. And I hope Stephen's grandfather is okay.
Yeah, me too. Yeah, I haven't heard from him in a couple hours, and he was supposed to be turning in his work, but he's not in class either. Elizabeth, do you want to go over 1, 2, and 3? Those are the ones you worked on.
Yeah, sure, I can.
Okay.
Let's see.
You can share your screen. I will let you do that. Is Stephen here in town? Is he in Memphis or he?
He's got his number, I think it's 901 number.
Yeah, he's registered in DeSoto. So yeah, I don't know.
Can you see my screen?
Yes.
Oh, okay.
Yes,
All
I
right.
can.
All right. Let's see. I'm not very good at Heather's.
Hey, Elizabeth, I can share mine. I've got.
Sorry, that's not the right one anyway.
Yeah, let me share my screen.
Oh, okay.
Yeah.
I've got it straightened out. I fixed it.
Let's see.
You'll have to stop sharing and then I'll share.
There we go.
Okay, I've got 2 screens, so let's see.
Yeah,
Here.
That's the one benefit of being downstairs. I've got 2 screens.
Oh, I can't work without 2 screens. Can you see it now?
No, not
No.
yet.
Okay,
Upstairs,
here
I'm
we
on
go.
the Surface Pro, so at any rate, we'll see.
All right, there we go.
Yeah, now it's coming. Yes, see, you got it all nice.
Okay. The first question, how well is Jones Electric Distribution performing, and what must they do well to succeed? The company sales have increased historically every year, with expecting increasing sales in the current year and increasing net income. So with that, it comes increased operating expenses, accounts payables, causing the company to be in a current cash poor position. The results in Jones having to miss out and taking advantage of the 2% discounts from his suppliers, which it says that he relies heavily on that. Let's see, is causing his profits to suffer and his line of credit to reach its max limit. Jones will have successful continuity and growth by finding a lender that will provide him with the larger line of credit to match his expanding business during this time of growth. Let's see, the second question was, why would a business that has a profit of $30,000 a year annually need a bank loan? Well, this company started out at a certain size, and their growth and expanding over the years, and this requires additional funds for the need of increasing fixed assets, things like supplies, inventory, and possibly new employees to grow. So in turn, this will produce larger amounts of income over the years. And what drove the increase in Jones accounts receivable and inventory balances in 2005 and 6? The company's sales increased during this time frame, increasing customer purchases. So the increase of customer sales and trading provisions have resulted in an increase in customer accounts with pending payments. So the need for additional inventory for the growth and production and forecasted sales has resulted in the increase in inventory.
Good deal. All right, and Stephen was working on 4, 5, and 6. So I got 7, 8, and 9. 7 was, how attractive is it for Jones to take the trade discounts? But I've got taking the trade discounts reduces operating costs, which will in turn increase the company profits. Timely payments, they strengthen relationships with your suppliers. If you're not paying on time, then the suppliers aren't going to want to sell you products. Let's see, I can't see all the screen. Okay. But if you pay your suppliers faster than cash is coming back into the business, then you'll have a cash deficit. Jones can still pay his suppliers on time without taking the 2% discount. And he can recuperate the loss in profit by charging higher prices to his customers. And if the business continues to grow at a rapid pace, Jones will still need additional financing, whether or not the trade discount is taken. His biggest concern right now is continued business growth and maintaining positive cash flows. Would you, as Ms. Montrose, agree to lend Jones the money needed? They've had positive sales growth. The company is on track to have another good year in 2007. Their sales are projected to exceed 2006 sales by over 20%. Jones has good relationships with their suppliers, which will help support continued business growth. The current ratio has been positive over the years. It's at 1.64 in 2006, but has dropped to 0.88 with recent expenditures that produce a need for financing. With Jones Electric growth potential and track record, I would extend the credit. If they can't secure the bank loan, then he has a few options to improve cash flow. He can request extended payment terms with his suppliers from net 30 to maybe net 45 or maybe even net 60. He could offer payment discounts to his larger customers so he can improve his collection rate. And he could work on consigned inventory programs so that he doesn't have to spend the money on inventory up front, have it available for his customers. And that's all I've got.
I have a question on one part of this.
Okay.
Oh, well, the line of credit, $350,000 to, but he's going to have to sever his ties with the other bank of $250,000. So, I mean, that's giving him a little bit of help, but
not much, right? It's only $100,000.
Right, because he's going to have to pay them $250,000 to, exhaust that.
Mm-hmm. Those suggestions for alternatives were good, and they are not in the case. They're not in the solution. Both of those are good about payment terms for their large customers and taking inventory on consignment. Those are both good options and interesting ones. Okay, give me back my screen, and I will show.
Okay.
I will tell you what all. Let me find Jones solution. There it is. Now, if I can figure out how to share it, I will. Jones solution. There we go. Okay, there's the questions and the exhibits. Okay, there we go. Let me get all the way up here. Their sales growth has been good, 18%, but their accounts payable has grown by 78%. Not exactly awesome. This was in the solution, this owner's salary, and you don't need it. It wasn't in the case. It was never in there. You can see by the day's sales right there in accounts payable, they stopped taking the discount. That was the issue. They needed the money. They needed to hold the cash in hand. That's what the issue was. Let me tell you what I thought was interesting about this case. Most of the time when we're looking at a firm that needs additional funding, it's fixed assets. And in this case, it's not. It's working capital. They're short on working capital. That's where their problem is. So let me show you some of these solutions. Here's their sources and uses. You can see their bank borrowing has gone up 37%. Trade credit up 31%. Retained earnings is only supplying 22%. Inventory has gone up 98%. Now, this is a wonderful thing. They're growing. That's great. They're doing great, except they need cash to support it. Inventory is growing 98%. Accounts receivable is growing 32%. I'm going to show you all. When you see the little TN in the tab down here, that means it came to me from the teaching note. The major reason, as Elizabeth said, for the growth in all of this is the increase in sales. I mean, what else? There. That's just where they're talking about it. Now, here's the one I didn't think, because you talked about the discount. Do you remember this from 338? The cost of taking the discount is what it is. The cost of hanging on to that money is basically 37%. Effectively, it's 44%. And think about what you're saying. Either for $1,000, they either pay $1,000, they pay $980 in 10 days, or $1,000 in 30 days. He's quit taking the discounts because he needed to hold on to that money for the extra 20 days. But that was costing him that kind of a rate. Now, this analysis, you're going to have to kind of look at this. And this is posted out there, and it will be available tonight. And let me scroll up here. Based on these discounts, if you take the discounts, same sales, the cost of goods sold is going to be higher if you skip the discounts. It's going to change their net income quite a bit, actually. But come down here to the balance sheet. If they take the discounts, they're going to need even more than $350,000. If they skip them, they can almost stay there, almost under the 350. But let me get down here to the bottom. Where is it? It must be on the next one. Part of the loan agreement with the new bank, Southern Trust, whatever, was 75% of accounts receivable, 50% of inventory. Both of those are in the 200 range. They're not up at 350. So if they skip the discounts and hold on to their money, they're going to need a line of credit no matter what. This is over here. This is a calculation. Let me blow it up. This is their sustainable growth rate. They can grow 5.7% and not have to go outside for any money. And remember what we looked at. They're growing at 20%. So let me find the one that did the thing that I wanted to show. I know it's on one of these little suckers. I'll find it. My God, they've given me everything on the planet. Well, go back over here. Yeah, if they're saying, where's the balance sheet? Balance sheet, balance sheet, balance sheet. Yeah, here we go. 75% of, 75% of accounts receivable is 218, 50% of inventory is 216. The bank has said that that would be the max they would let them have, even though the line of credit is 350. So they're going to need more money. So what options do they have? Let me get down here. Well, they can continue to rely on trade credit, but basically they need to get their sales under control. I mean, that sounds like a horrible thing to say, but they don't have the cash to support the sales growth. Is that bad or what? I mean, that's a sad thing to say. My gosh, they're growing so fast, but they simply don't have the money to support it. They don't have the cash out there to support it. Now, possibly some of Heather's suggestions might work. If they could get some kind of deal with their big customers to pay sooner, or take inventory on consignment where they didn't have to pay for it.
Well, I mean, what else could they do? Could they have an investor maybe buy in? I thought maybe he could get a partner. He's buying his partner out. Would a partner help?
A partner could help. Because as you see, his main problem is cash. It's not fixed assets. I mean, what fixed assets has he got? Probably a warehouse. I mean, you know, let me go back over here and look at it. Case exhibits. Net income. Where is this fixed assets? Yeah, the fixed assets don't change. Property, plant, and equipment, yeah, they did go up some, but I mean, think about it. He's electrical parts. What would you have? A warehouse, a
forklift, pallet racking, maybe.
Yeah, I mean, stuff like that. But it's and he'd like to grow it. He'd like to have another facility. It said that in there. That's why he'd like to do business with a bigger bank, so that he could expand out of the area. But he's going to have to figure out where he's going to get the money to do that. You still like the case? It's interesting. And you can see what I mean about there's not exactly a correct answer. I mean, and this would not be an unusual case for you to be faced with in business. Well, what do I do? I mean, sales growth was 18%, and you can't sustain that. They can sustain about, what did we say over here? Sales growth, 5.7%. And we looked at that two different ways. Mm-hmm.
But how do you cap your sales growth?
That would be tough. That would actually
If the demand's there, how do you we can't sell to you, Mr. Customer?
Yeah, I mean, I don't know how you do that. I mean, I truly don't. I mean, what do you do? Lay off salespeople? I mean,
refuse business just outright.
I mean, theoretically, we can say, well, they can only grow by this much. I have no idea, but he's got to figure something out because he doesn't have the cash to support what he's doing. Interesting. Anybody else comments on this? Who's our group 2? Where's my group 2? Shara, Shay, JD.
It's quite the scenario here. My thinking is exactly more or less, I don't know what my thinking is more or less. The truth is here, he's in quite the scenario here to grow and have the potential to do whatever he wants. And he just doesn't have the ability to do that without.
And that's a sad thing. I mean,
yeah.
Think about it. That's sad. I mean, he's poised to grow.
I mean, if he's growing this rapidly, you think, put your business up as collateral or whatever, your building or whatever, let's say a couple $100,000, if it's not already locked in, already have liens on it anyways. But that's the only thing I can think of, truthfully, from that aspect to get the cash. You know what I mean?
Yeah. He's got to figure some way to improve his cash position, reduce his inventory position, or reduce his accounts receivable position.
Yeah.
Some of those. I mean, it's all tied up in there. Like I say, that's what I thought was interesting because we just looked at the thing last week on AFN, and that's really focused on fixed assets. This is kind of a different view. It's like he doesn't need fixed assets. He needs cash.
Yeah.
Shay, Jarrett, any comment?
Do you think if he was able to somehow slow down his growth of sales for a little bit and then kind of just focus on getting that cash, then he could start going back to having the rapid sales growth, or would that even work?
That's a scary thing in business.
Yeah.
That thought, in my opinion, is just super scary to think that word spreads from negative growth. And this is purely off my, experience here. It's just, bad travel's more than good. So you say, look, give me 2-3 months and I'll come back to you. We're like, well,
they'll find somebody else
over here is just so cocky with himself. I'll just go over here to Bob. You know what I mean?
Mm-hmm.
So the scenario's there, but it's scary from an aspect of business. It's what I think anyways.
Yeah. I don't know how you do it. I'll have to think of somebody who owns a business like this. Of course, right now it's so bad, everything's so bad. Who knows? But what would you do? What would you do? Let me see if any of you can think of somebody who owns a business, anything related to this. What do you do to get it under control? If you need cash, you've gone to the bank. I mean, his credit is good. It's not that. His credit's good. He got references. Yeah.
I'm just putting everything. If I know that I can get it back with, X amount of years there, say I have a farm with 200 something acres that's personally mine. Hey, put it up. I mean, that's potentially, depending on where you're at, $1 million worth of land there, if not more.
What did
So
he had? He and his wife bought a house.
Yeah, he's only got a house that's worth like $200,000.
And with a mortgage of 117.
Yeah,
He hadn't got
so
a lot.
he has nothing.
he has nothing. Yeah.
Okay.
Well, sadly the lottery was hit, and it's only down to 20 million, but still that would help. So no, I'm just
Yeah,
kidding.
the lottery would definitely help.
Jones Electric would not exist. No.
It would help all of us. I mean, I can go with lottery. Okay, I'm looking for, I think it's this one I want right there. Okay, look right here. Could he, 75% of accounts receivable. If he could convert more of that money to cash, that might help.
So really hit up people that owe him money.
Yeah. Be more aggressive in his collection policy, I guess.
Yeah.
Lines of credit payable. See, that's gone up. Accounts payable is real, but the accounts payable went up because he quit taking the discounts. That's what happened right there. He doesn't really have a lot of long-term debt. Current position. Yeah,
Nothing.
it hadn't changed. Nothing there. Net worth. I mean, you got me. I can't honestly say I know either. Like I said, some of these cases. Yeah, stop sharing. There we go. Some of these cases don't have an obvious answer. Harvard gives, or whoever wrote it. I don't know who wrote this. They're not all written by Harvard. No, it's paragraph. Yeah. Thomas Piper and written by Jeffrey DeVolder. They were at Harvard. They're written by people at Virginia, Darden. They're written by people all over the country. They're part of Harvard cases. And they provide me with a solution, but it's not necessarily the right one or the only one. That's what's supposed to make this class interesting. Y'all look thrilled. You just look thrilled. I know, because finance is normally like math. Either you're right or you're wrong.
Right.
That's it. This is so completely, and that's what I like about it. It's like accounting. It's supposed to, they call it a balance sheet. Guess what? If it doesn't balance, it's wrong. End of discussion. Go back and look again. In this case, not so much. So it takes a while to kind of get the hang of this case, this class. What are we doing over here? I'm sensing movement behind me, but they're just looking at me. Okay, I will talk some. I'll just go ahead and talk about weighted average cost of capital. Let me find it. There it is, cost of capital. Let me share that. This is going to be, where is it? No, that ain't it. This one's it. There we go. This is going to be a lot of review because a lot of it is coming from 331 and 338 probably. But we need to review it before we go a little bit further into cost of capital. Okay. Cost of capital components. You know what they are. Debt, preferred, and common equity. We almost never have preferred. And there they are. There's our components. There's our formula. You've seen it a billion times. Our component cost. And we're going to talk about each of those pretty much like we did in 331. Capital components come from sources of funding from investors. That means accounts payable, accruals, deferred taxes. They're not sources from investors. They're sources of cash. They're not included. Those are line item adjustments. Cost of debt. You got three ways of getting it. If you don't have debt, you can ask an investment banker what the coupon rate would be on debt if you decided to issue some. And we'll look at some of those. You could find the bond rating for the company and use the yield on other bonds with a similar rating. The easiest. If the company's got debt outstanding, you find the yield of maturity on the company's outstanding debt. That's probably what they could issue new debt for. And here's our example. 22-year, 9% semi-annual coupon. Bond sells for $835.42. Calculator solution. I know you all know how to do this. It's semi-annual, so you have to multiply by 2. And it's after tax. And this is an older slide, so we're still using 40% tax. Now, flotation cost on debt. We ignored those. I'm thinking in 331, we definitely ignored them. I think in 338, we talked about them. We frequently do ignore them because they're low. There is such a thing called project financing that adjusts the project for the flotation cost. We're not going to deal with that. Here's what happens when you adjust debt, the cost of debt for flotation. Notice what you're solving for, what you have on the left is the face value after flotation. And we'll see an example. The interest is after tax. The solution rate is after tax and after flotation. Here's what we look like. This company in the example can issue 30-year bonds. So N is semi-annual, N is 60. 11% annual coupon rate. Coupons are paid semi-annually. It's after tax, so the payment is 33. Flotation cost is 1%. So this number right over here is going to be 990. Face value is 1,000. Here's what goes in your calculator. N is 60. The 990 is what goes over here on the left. The 33 goes in payment. The 1,000 goes in face value. It's semi-annual and you still have to double it, but this is already after tax because that's what you were solving for, was the after tax. Now, preferred stock. We do include flotation cost here because it is, it is usually relevant. And there's an example. Preferred dividend. In this case, what is it, $10? Yeah. Preferred selling price. It's not the par value. It's what it's selling for right now. $100. Flotation is 2.5%. Plug that in and we get a cost of preferred. I'm sure you remember common equity. 2 ways to raise equity. Directly, issuing new shares. Indirectly, using retained earnings. Here's the deal with new common equity. Mature firms don't do it very often. The flotation cost is very high. It is a very negative signal to the market, and we're going to look at some cases of that. It puts downward pressure on the stock price. Here's what happens. If a firm, and the logic sort of is supposed to be that if a firm wants to use money for something, first place they're going to go is retained earnings because they've already got it. So they don't tell anybody what they're doing with it until the annual meeting. If they need more money, they're going to go to debt because debt is lower cost and it doesn't reduce their percentage of ownership, assuming they're part owners. So the last resort is new equity. It implies that they've run through all their other sources. It has high flotation cost. And what will happen is, and I believe we're going to look at a case of this, what's going to happen is the firm's stock is selling for $20. They announce that they're going to issue new stock, and before they can do it, the price drops because it's a negative signal. So now they have to issue more stock to get the money that they wanted. There. Retained earnings. Retained earnings is an opportunity cost. Remember, retained earnings belongs to the shareholders. Think about the income statement. You get down to the bottom, net income, you either pay it out as dividends or you book it to retained earnings. It belongs to the shareholders. They could have done something else with it if you gave it to them, so it's not free. It is an opportunity cost. They could buy similar stock. The company could have used it to repurchase their own stock. 3 ways to get it. I know you remember all 3 of these from 331. CAPM, discounted cash flow, and owned bond yield plus risk premium. CAPM, we have to estimate the risk-free rate. For stock, we are typically using the long bond, the 30-year treasury bond. We've got to estimate a market risk premium or the expected return on the market. We usually use S&P 500 for the market. Have to estimate beta. We're going to look at doing that. When you plug them all in, you get an answer. The catch is, look what you just did. You estimated, and you estimated. Now, risk-free rate, as I just said. If we're looking at options and futures, we use the T-bill rate as the risk-free rate. If we're looking at stock, we use a treasury bond, the long bond, which is now the 30-year bond. Estimating the market risk premium. This is interesting, and I didn't update it with new numbers. We'll see some here in a minute. Ibbotson and Associates, Roger Ibbotson, keeps numbers from 1926 to the most current year. The arithmetic mean is 6.5, geometric 4.9. So that's probably your best future. We want to be forward looking. Here's some estimates I've done in different years. And what I want to show you is analysts typically don't look at dividend growth. They look at earnings growth. If you look at dividend growth and go all the way through this, in 2008, the market risk premium was 11.73. If you use earnings growth, it's 17.79. Same numbers, 261, etc. Hop forward to 2011. Dividend growth, 3.395. Earnings growth, 133. 2013, dividend growth, 14.8. Earnings growth, 6.67. And 2017, 13 and 5. I didn't redo it for this year because the whole point is what you get using earnings growth and dividend growth are very different. Very, very different. Analysts estimate this. We're trying to estimate this. And you can see we can get pretty far off. Most analysts use a 5 to 6.5. Most times for the return on the market, we use the S&P 500. Brigham Davies use numbers in that. That's 338. Okay, beta. Beta estimates are noisy. It's got a pretty wide confidence interval. And all you can do with beta is historical, of course. There's 2 or 3 ways of doing it, several. One approach is to use 4 to 5 years of monthly data. So figure 5 years of monthly, that's what? 60 observations. 2 years of weekly data, 104. Either way, look, particularly the 4 to 5 years. What if the whole risk profile of the company changes in the last year or two? Think like a rolling average. It's going to take a long time for those new numbers to get incorporated in. There are some other issues with adjusted beta and fundamental beta. Adjusted beta is based on a concept from Marshall Bloom, who over time, the beta of companies moves toward 1. Very slightly, but it moves toward 1 every year. It's kind of a survivorship thing. And it kind of makes sense if you think of it. When a company starts out, their beta is real high because they're real volatile. Their returns are all over the place. If they survive and grow, they eventually get to the point where they pretty much move with the market. So there's an adjustment called a Bloom's adjustment that adjusts beta slightly toward 1 every time. Fundamental beta, and companies who estimate beta will tell you what they're doing. Fundamental beta would apply particularly to this 4 to 5 years. The analyst would go in there and look at it and say, you know what, we got a beta of 1.1, but in the last couple of years, this company's really taken on some risky projects. We think we should adjust the beta to 1.25, and they do it. And of course, you've got multinational issues. You're using the domestic market to estimate beta, but we've got some multinational issues in there. Okay, I forgot what the name of this company, National Chemical or something. Here's what we've got. Risk-free rate's 8%, return, market risk premium 6, beta's 1.1. Plug it in, cap in, you got it, 14.6. That's easy. Okay, discounted cash flow. Current stock price is easy. You can observe that. Current dividend is easy. You can observe that. The growth rate, not so easy. You cannot observe that one. So you can use the historical growth rate if you believe the future is going to be like the past. Here's the catch with that. You're looking at a compound annual growth rate. Think about those we just looked at there, where when you're getting compound annual, you're only using the first year and the last year. Whatever happens in between doesn't make any difference. So it's very sensitive to where you start. You shift up and down a couple of years, it can be very different. You can use the earnings retention model, which we'll look at, or analyst estimates. Earnings retention. ROE times dividend payout. There. Retention rate's 48. There you go. So they get a growth rate of 7, which is reasonable. Now, you can only do this if the retention rate is constant. They think the ROE on new investments is constant. They're not going to issue any new stock, and they're not going to take on any risky projects. Analyst estimate, we just looked at that. They estimate earnings growth. If you use that as a proxy for dividend growth, you can see how divergent that is. That's a tough one to use. Analyst estimate for this company, more or less 6.9. So here's our numbers. Plug them in, 14.5. So we've got a 14.6 and a 14.5. This own bond yield thing is back to Roger Ibbotson again. With his tables, we're assuming that this company is, say, AAA rated bonds. And we're looking at the difference between the return on AAA rated bonds and what? Large cap stock. That's where the bond yield number, that's where that comes. You just add it on to the return on debt. Conveniently, we now have 14.5, 14.6, and 14.7. Didn't they make that come out neatly? There they are. Most companies, as you can see, use this one. They use CAPM. Okay, what about flotation costs for new equity? You have to use a discounted dividend model because that's the only place you can put it, is right there. We have a flotation cost of 12.5%, which is not uncommon. You can see it drove the cost of equity up by a whole percentage point. Okay, going to put it all together. We need the weights, the percentages of the firm that will be financed by each component. You should always use target weights if you know them. Here's the catch. If you're on the inside of the firm, you will know the target weights. If you're on the outside, you may not know. But a firm has a target. They may not be right on it, but they have a target. They have a plan. We want to be 60% equity, 40% debt. In this case, it's 30, 10, and 60. So you plug those numbers in, and we get a cost of capital of 11.77%. Now, we are only concerned with after-tax costs. We are concerned with marginal cost. In other words, we don't care what it cost you last year. We won't care what the next dollar is going to cost you. Because cost of capital, 99% of the time, is used for forward thinking. You're evaluating future projects. Target weights. Target weights by far the best, better than book values. You can use market value if you have to. They're better than book value. And market value of debt's not known. You can use book value. Now think about target weights. Think about your own weight. You have a weight. I want to weigh 110 pounds. I may never actually weigh exactly 110 pounds, but that's my target weight. When we're dealing with companies and you know the target weight, that's what you use. Okay, here we're going to estimate the weights. Stock price is $50. We got 3 million shares. They're giving us the amount of preferred and debt. So there's our value of equity, 150 million. Total value of the firm, 250 million. Stock price, there you go. There's the value, 150.75. There's our weights. I made it work to come out the same number, but that's how it works. Now, what can a firm do to influence its costs? I have no idea what I just did. Oh, well. Influence. Market conditions influence, and they really don't have any control over that. If interest rates go up, the cost of all components goes up. Market risk premium can go up. If tax rates go up, the cost of debt goes down. The firm's capital structure. Debt is cheaper than equity. I mean, there it is. Their dividend policy. If they pay out less in dividends, they have to go to the market for money less often. If they take on riskier projects, they're going to have a higher cost of capital because investors are going to demand a higher return. Now, I'm going to talk about risk adjusted. The composite cost of capital, the WACC, it's to be used for the average project of the firm. You hear a firm talk about their hurdle rate. Well, that's their average cost of capital. Different projects, different divisions may have different risk, and you need to adjust for that. If you don't, here's our little goodie. If you just have this as a hurdle rate right here, you're going to reject everything with a rate of return down here, except everything up there. If you adjust for risk, you will accept these and reject those. Now, what happens if you don't do that? If you don't do that, over time, you'll become riskier because you have rejected all of these low-risk projects and you've taken on these high-risk projects that you shouldn't have. Here's an example. Cost of capital is 15%, and there's our projects. Oops, let me back up one. Whoop. If I could make, no, there we go. Back up one more. Okay. Okay, there's their calculated internal rate of return. Cost of money is 15%. You'll take A and B, reject C. If you risk adjust, then you will reject A and take C. A is up there on the right-hand side. C was down there on the left-hand side of that graph. Now, how would you do these divisional costs of capital? Well, you could estimate a cost of capital as if it were a standalone firm. That requires estimating the division's beta, cost of debt, etc. Not easy. I love this one. The pure play method. Find several publicly traded companies exclusively in the project's business and use them. This is really hard to find. Now we're going to look at projects. We're going to look coming up here, particularly with Ameritrade, where you've got comparable companies. But to think of finding a company that does exactly what this division of your company is going to do, this is really hard. And we're going to talk about this unlevering and re-levering. Here's an example here, Huron Steel. They've got 3 divisions, risk-free rate, market risk premium. We have a beta for each of their divisions and an overall beta. We have a cost of capital for each of their divisions overall and a percentage of business. Now, the beta for the company is a weighted average of the betas of the divisions. The percentage of business is the weight. Same with the cost of capital. There you go. Here's how we got those costs of capital. We used their betas. There we got them. It's a weighted average. Now think about the implication of that. I'm beginning to hear little sounds over here. Hang on 2 seconds. Come on, everybody. Hang tough. I think they're deciding it's dinner time. If you know, suppose you know this one, this right here, you know this, and you know 2 of these, you can find the 3rd one. Same's true with cost of capital. Now, another approach is more subjective. You consider the project's relative risk to the firm overall. A lot of times you're going to see this in a big corporation. They will put out directions to their division saying, for your analysis for capital budgeting for next year, your cost of capital is 10%, +2 for high risk, -2 for low risk. Something like that. It's purely subjective. Now, let's look at it with flotation cost. New debt and new common equity. It only drove it up. This is only new debt. It only drove it up 0.2%. from 1177 to 1179. If you add new common equity, it drives it up to 12.4 because equity costs a lot more. Yep, we're hearing from him. Hang on 2 seconds. You've been so good. Okay, I've got him in my lap. Hopefully this will work until we get done here. Okay. No new issues, 1177. Debt, see, didn't drive it up much, but new equity does it. Now, increasing marginal cost of capital. Externally raised funds have flotation costs, so it increases the cost of capital. You just saw that back there, right there. Investors perceive large capital budgets as risky, so that may drive it up. If external funds have to be raised, then all projects are evaluated at the new cost of capital. So here's the thinking. Here's where we were. Let's say we can go up to 500 million without going outside for any money. But we think we'd like to go to 700 million. To do that, we're going to have to raise both debt and equity. So the new cost of money is going to be 12.4. So we've got to go back and analyze all of these projects at the 12.4. And some of them are going to drop out because they were okay at 11.8, but they're not at 12.4. So it's kind of an iterative process to find where you are. Current yield of maturity, coupon rate on debt doesn't matter. Current yield of maturity. You don't want to mix current historical measures. Target weights. Target weights if you have them, market value if you don't. Only investor provided funding. Now, that was all a review from 338. Let's talk about something a little different. Let's look at the balance sheet and the cost of money. If we just ignore, in this case, we're ignoring taxes, and we're ignoring preferred. Cost of money is the cost of debt, weighted cost of debt and cost of equity. That's your balance sheet right there, right? Okay, without tax effects, that's what it is. The cost of capital is the required return on all of your assets. Because look back here. If it's weighted there, those are your assets. Now, asset betas. We've got asset betas and equity betas. This is asset, and it takes into account debt. This is equity. The beta of debt, and you probably never thought about debt as having a beta. It's frequently assumed to be 0. It's always assumed to be low, 0.2 to 0.3. The beta of equity, we estimate from a regression, and we're going to look at how we do that. Now, to estimate betas, it's called the market model. I'm trying to estimate that right there. This is the return over time on my, whatever my stock is. This is the return on the market. I use a regression to estimate it, and I'll show you one here in a minute. That's what I'm trying to get. I calculate the returns, probably use the S&P 500, do a regression, and I'll get data. Now, price data is readily available, but we need returns. We're regressing returns. So we have to convert the prices to returns. And there's how you do it. If the stock didn't split, it's the new price minus the old price plus any dividend. If it's split, you have to take that into account. Here's an example, and I'll pull up the actual spreadsheet here in a minute. But you can see we've got return over here. When we run the ANOVA, there it is, beta's 2.3 right there. Now, here's the thing. For a company, okay, let's just look at a single company. We've got an equity beta through regression. There's reasons why we would want to unlever it, take out the effect of debt. One reason would be the firm right now has 20% debt and they're thinking about going to 40% debt, and we need to find out what effect that's going to have. The other reason would be we're going to use this firm as a comparable and use its beta to estimate my target firm's beta. I've got to take out the effect of debt. This is your levered right here. This is unlevered. Asset is unlevered. Equity is levered. This is assuming with the beta of debt of 0. If the beta of debt is 0, then the return on debt is the risk-free rate. That term is 0. This whole second component drops out. So that's what you've got. This might be new. There. When it's not equal to 0, then here's what you've got. There's the beta of equity. There's the beta of debt. Now, there you go. Now, we know weighted average cost of capital is a weighted average of the cost of capital for a firm. Okay. Equity betas include debt. Asset betas do not. So I'm going to pull up another thing here that's going to talk a little bit about Ameritrade, because Ameritrade, in your case, doesn't have, they haven't been out there long enough to have their own beta. So you're going to have to use comparables. So what you have to do is unlever each comparable to get their asset beta, to take out the effect of whatever debt they've got. Then you average the unlevered betas and re-lever it to reflect the debt level of Ameritrade, in this case, of your target. And let me show you that one. Ameritrade. There we go. Am I sharing the right thing? I have absolutely no idea. Yeah, well, stop that share. Let me go. Cost of capital, the Ameritrade. That's the one I want. Right there. Okay. Okay. There's your standard formula right up there, taking taxes in now. This is the expected return on all assets. Now, you can use CAPM on debt. If it's got a beta, you can use it. I mean, why not? Now, asset betas. Like I say, it's assumed to be 0 or 20 to 4 to 30. Right there. Select a proxy for the risk-free rate. Estimate the market risk premium. Select appropriate comparables. Estimate equity betas for each comparable by regression if you have to. I believe in Ameritrade, I think they're given to you. Use the estimated betas and assumptions and unlever them. In other words, you're going to have an equity beta and it's going to tell you the firm's got 35% debt. You have to back that out. You average the unlevered asset betas and then lever them back to match your target. Then you use CAPM. Now, we've talked about the risk-free rate. I'm not going to go too far into that. We've talked about market risk premium. Okay, proxy for the risk premium. I'm trying to go, because some of this was, if the firm doesn't have published data, you've got to look at comparables. And that's what Ameritrade is doing. Ameritrade lists 14 firms in 3 categories: investment services, internet. I've never heard of Mecla Media. Never heard of it. This is an old case. And discount. You have to estimate the betas for those. Equity betas depend on the capital structure. I'm going to pull up. Again, we're going to use the market model. You're not going to have to use the regression. This is the same because I usually do it on 2 different nights. Use the formulas on the next slide. The Harvard case ignores tax, but you know. Debt to equity is not percentage of debt. It's debt to equity. So be careful which one you're using. The formula for cost of capital uses a percent of debt, but this is not percent of debt. This is debt to equity. Asset betas. There's your equity beta. Turn it around to an asset beta. The equity beta is going to be larger because it's got the, remember, when a firm takes on debt, the risk of that debt is focused on the shareholders. It drives their beta up. So an equity beta is larger always than an asset beta. There's where we're doing this. That comes down there. Average the betas, lever them, and use them to get a cost of capital. Now I want to show you I can pull up the Ameritrade. I want to show you the regression. I'll show you two different things. Get my little regression over here. Put that down. Get rid of a whole bunch of stuff on the screen. Okay. Stop that share. I want to share. Well, gimme. Regression. Okay. Here's how you do a regression. Here I've got the price, stock split, dividend. I've calculated return using that formula. I've got market return right over here. You can see the result right here. I am going to go to, where's data? Go away. Analysis. I want regression. Same window is going to pop open. My Y range is this right here. My X range is already there because I did this last night. X range. Okay. Must have the same number. Did I not get them right? I guess I didn't. Oh, I didn't. Which one? Let me take both these out and start over. Okay. The Y range is this, and the X range is that. Now do it. Okay. There it is. There's beta. 0.76. And here's the results over here. 0.76. That's how you get it. Now, let me go get something. Well, I can probably get it over here just as easy. And show you something. Case studies. I want templates. I want Ameritrade. Show you what it looks like. Oh, stop that share. I want Ameritrade. So Ameritrade. Ameritrade. There we go. Okay. There's their data. But here's where you're going to get in trouble. They haven't been out there. Now, here's a case where, see, they're not telling you what to use for the risk-free rate or for the market risk premium. They're giving you data, and you're going to have to pick it. These are selected data for comparable firms. You have to pick which ones to use. Exhibit 5. This is data for Ameritrade. We don't have enough data on Ameritrade to use it. We have plenty of data on Charles Schwab, prices, dividends, stock splits, etc. Here's all of that spread out. Let me blow it up a little bit. A.G. Edwards, Bear Stearns, etc. We've got value-weighted NYSE, Amex, and NASDAQ, equally weighted. You decide. Raymond James, Payne Weber. You decide which of those are the most comparable. And there's the equations that you need to use. Now, let me back over here and find the firms I wanted. Yep. They're giving you debt to capital, debt to value, and debt to capital, market values and book values. Stop sharing. Any comment? Yeah, that second part, I don't think, and let me show you one other little thing here. I can pull this up. Let me get over here to Blackboard. Go back to this. There is a video, and I'll find it here in a minute. Video tutorial on, there it is. I don't know that you're seeing my screen. I want to share this one. Okay. There's a video on how to do this. Beta, as we already know, is used in the CAPM equation to find the cost of equity. Finding a publicly traded firm's beta is pretty straightforward linear regression of the returns on the stock against the returns on the market over a period of time. Beta is the designated measure of a firm's systematic risk, its contribution to the risk of a well-diversified portfolio.
What we've gone on to learn is that a firm's equity beta is affected by the level of the firm's debt. Thus, if the firm's level of debt changes, so does its equity beta. In this tutorial, we're going to look at two examples of unlevering and relevering a firm's beta based on a change in the firm's level of debt. These are the two formulas we're going to work with. They are presented in a slightly different form than in most textbooks to highlight when you multiply and when you divide. The equation on top converts an unlevered beta to a levered one. You multiply. The equation below reverses the process, removing the effects of debt from a firm's beta. Both equations require the percentages of debt and equity and the firm's tax rate. Now let's look at the examples. Our example company A currently has no debt and a beta of 1.05. They're planning to change to 30% debt. Their tax rate is 40%. Since A has no debt, their 105 beta is unlevered. We want to lever it to reflect the effect of a 30% debt level. Levering a beta increases it, so we'll be multiplying. Below the given data, the components of the equation are calculated. 1 minus T, the percentage of equity, and the ratio of debt to equity. With those components, we can compute the levered beta of 1.32. Just as an added review, consider the effect this increase in beta has on the firm's cost of equity and the weighted average cost of capital. Given a risk-free rate of 4%, market return of 8%, and a cost of debt of 6%, we can see the changes the addition of debt brought. With zero debt, the cost of equity and the cost of capital were both 8.2. With 30% debt, the cost of equity rises to 9.28 to reflect the added risk focused on the equity holders, but the cost of capital declines to 7.576. Think about why. The after-tax cost of debt is 6% times 1 minus 0.4, or 3.6%. So even with the higher cost of equity, the addition of debt decreases the cost of capital. Now, this was a fairly simple example. Now let's look at company A again. Now they have 30% debt, but they're considering increasing that percentage to 40%. So our first step, assuming we didn't know our results from example 1, would be to unlever A's beta of 1.32 to remove the effect of the 30% debt. Unlevering will decrease beta, so we'll be dividing. Using the data as in example 1, we can get back to our unlevered beta of 1.05. Now we'll follow the same steps as in example 1 to lever the 105 beta to incorporate 40% debt. No surprise, higher percentage of debt, higher beta. Comparing the 30% debt to 40% debt and assuming the cost of debt at 40% level rises to 6.5, the cost of equity increases even more, but the cost of capital declines again. Same reason. Even with a higher cost of equity, with more debt, the lower cost of debt brings the cost of capital down. So when do we need to unlever and lever? 3 specific cases. As in our example 1, a firm has no debt and wants to evaluate the impact on their cost of equity and cost of capital of adding debt to their capital structure. You lever. As in example 2, a firm has some debt but wants to evaluate a change in the percentage of debt in their capital structure. Unlever and then relever. And number 3, you want to estimate a beta for a non-publicly traded firm, project, or division. Find comparable firms, their betas, and their percentages of debt. Unlever each comparable firm's beta, average the unlevered betas, and lever this average to reflect the debt level of your target. So it's an unlever and a relever. Those were the 3 primary occasions to solve for beta unlevered or beta levered. Keep in mind, a levered beta is larger than an unlevered beta for the same firm. Levering adds the effect of debt. It increases beta, so you multiply. Unlevering removes the debt effects. It decreases beta, so you divide. Hope walking through these examples and the uses of levering and unlevering equations will help you feel more comfortable about when to use them and how to use them.
Stop. Okay. I went on and let it play because that third case is exactly what a Ameritrade is. And it did walk you through it. That is posted out there. And actually, I think the spreadsheet that I used in the example is posted out there as well. Okay, questions on where we're headed next? Are we completely blown away yet, or are we just kind of getting close? It's going to be fine, I swear. Okay, next week we have Tire City is due, individual case, and I'll talk about that, of course, and Ameritrade and Marriott, and they are both cost of capital cases, I'm pretty sure. Go look at my. Yes, Marriott and Ameritrade, and they are both cost of capital cases. So, and kind of a Marriott is kind of more like the Huron Steel thing in the example. Ameritrade is more like the unlever relever thing that we just looked at. So we've covered what you need on both of those. Okay, questions about anything?
Hey, Dr. Kugley.
Yes.
I just want, it's not about a case, or it is about a case in a way. I did see your email that you sent out about, to my group about where our work was, for the case, like the write-up and stuff. I guess for some reason I was thinking we'd send it afterwards.
Oh yeah, I was thinking about financial health. That's what I was asking about, financial health.
Oh,
I need financial health.
I got you.
I just wanted to, you're not going to get a grade on it, so it doesn't matter. It was just for you to get to kind of see a case, see what, kind of see what one looked like, a little bitty case, an itty bitty case.
I did email you the write-up and the template for Jones Electric.
Okay, yeah, I've got it.
Okay,
my email's on my other screen.
Okay, so you do want us to send you one for the financial help?
Yeah, send me what you did. Yeah, but after this, the individual cases are uploaded in Blackboard like an assignment.
Okay.
You know what I mean? You go back where you got it and upload it. Yeah. Okay. Any other questions? You all know. You have had me already know. Anytime, email me. Hey, Daphne. She turned her camera on.
Hey.
Good to see everybody's face. Okay. Any questions? And I hope Stephen, let me know if you hear from him. I hope.
Yeah, we will. We'll let you know.
That's tough. And I'm certainly obviously not going to dock you for that. Y'all did good in a bad situation. I mean, there's nothing much you can do. I hope his grandfather's okay. It's tough. It's scary out there. I'm sick of wearing a mask. I have a new one on order. It should be here this week. I don't know how this is going to work. It has little clips and it magnetizes. It's clear plastic and it magnetizes to my glasses. I might be able to breathe. I'm so excited. I know. Well, I've got one that goes, like as the band. Somebody gave me that, but that screws up your hair. I mean, so I'm not doing that. Forget that. That's out. And you can buy them. I had a friend who I saw her daughter and she had them. They're made onto glasses, which if you don't wear glasses works fine. But if you wear glasses, that doesn't work. So I looked on Etsy and you can buy them with little clips or with little clips that have magnets and it just magnetizes right on your glasses. I'll let y'all know next week how this works. But I thought this is going to be awesome. I mean, I can see people. They can see me. I can probably breathe.
My mother said she wants what the glasses thing. She would like to know how it works.
Yeah. I'll send you the link where I bought it. I'll let you know. It has shipped. I haven't got it yet, but I got the notice today, I think, that it's shipped. So I figured, you know what? This is worth a try because I'm sick of all the rest of it. I mean, I'm sick of it.
That's
Okay.
fun.
Hey, Dr. Kugler.
Yes.
I got one little question.
Okay.
And I'm just curious. Maybe I'm looking for something that's kind of more so going to help me feel better, I guess. But do you know or remember of any former student, for this class specifically, any former students that came in and maybe after the first case or whatever, or around the first case, they were worried, didn't know how they were going to handle this class, yada, yada, yada. But in the long run, they ended up doing fine and everything.
Yes. Yes.
Okay.
Quite a few. In fact, on my office door, Cooper, hush. I've got one in my lap, but the other one, I have no idea what he's doing. I have a share of RJR Nabisco that he gave me, bought it on eBay for me, because he said about halfway through the class, we watched part of the movie Barbarians at the Gate. And he said it was about halfway, and that was about RJR Nabisco. He said that was about the case, the point where I finally realized what we were doing. and like how it's supposed to work. So yeah, this is so different. And I hate that we're not, not live, at least some of us live. It's just so different. There's no book. There's no real, this is the right answer. Like say, we're all numbers people. 2 + 2 is 4. End. The period. The end. Well, maybe not so much. So this is to make you think. In fact, I might contact him and see if I can get him to talk to the class. We could Zoom him in because I think he's a financial analyst at FedEx right now. I'll have to contact him because that might be good for y'all to hear from him.
Yeah.
He was just, I have no idea what's going on here. I'm just, And then he said, all of a sudden it clicked. This is what it's going to be like in the real world. They're not going to give you all the data you need. They may not even give you the questions. I mean, here it is. What do you think we ought to do? Type thing. So let me see if I can contact him and I'll get him to come talk to us.
Okay.
Did that make you feel better?
Oh no, it did. It did.
Good.
It really did.
Trust me.
What about like, as far as when we have to take like the test and stuff. So the tests
Okay.
are all completely in Excel?
Yes. Okay. And let me say this about the test.
Okay.
While the test is set like a case, it's not, there is an answer for those. The test is more a test of, can you do the techniques that we're learning? In other words, there is a definite answer for the test. Okay. Here's the data, unlever the betas, get the, that kind of thing. The cases are made to make you think, well, what do you think I should use for the risk-free rate? Like I showed you that thing, they gave you a whole list of different rates. You defend which one you're going to use. On the test, I'm going to tell you, the risk-free rate's 5%. Market risk premium is 7. Go for it. The test is meant to be sure you're comfortable using Excel and executing the techniques. Computing the weighted average cost of capital. Unlevering and re-levering beta, doing that kind of thing. There's no regression in there. I want you to know how to do it, but I think Dr. Liebenberg made you already do one. I think I thought she did. Yeah. Yeah, I thought so, but that's not in there.
And so you'll do a review for before the test, we'll do like a review and you'll just kind of, you'll basically go over exactly what's going to be on it and give us.
I will. Think about what we did last week. The AFN, I can tell you already, part of the test is AFN formula and to do the percent of sales. That I can tell you already, it's on there because it's a fundamental technique, but there's no guessing about what you're doing. Here's the numbers, do it, forecast it. The cases are to make you think. The tests are to test your can you handle the methodology, I guess. That make you feel better?
It does. I mean, that's my biggest deal is as long as we just have and I know you've always done a review, you've done things like that, but as long as we have some type of, review like that. And, I know you're not going to say this is exactly, but just things like that. And I can know how to do it. And then I can take the rest of that week to brush up on everything and then be ready for the test. And I feel like I'll be just fine.
Oh, you will. Okay. Those of you that had me for 331, think about the CapEx project. Guess what something in capital budgeting is going to look like? Because there's no question about what the answer is. Here's the data, do it. It's going to look like that. So no, the cases are to make you think, and there's not specifically necessarily, if you can defend your results, I'm good. I mean, we think they ought to do this because the tests are strictly calculation.
Okay.
And actually at this point, he's growling in my lap. Little face. There we go. There's a little puppy face. This is Riley. Yes, I know, sweetheart. It's almost dinner time. I know. We won't even use any functions, I don't think, until we get to like net present value and internal rate of return. I mean, the Excel is add, subtract, multiply, divide. Yes, look at the camera. Look cute. The other one's over here. Look, also looking cute. Okay. Anything else, guys? We good? Terrific. Any other questions? Anytime. You know, I'm here. That ought to do it. The solutions to Jones and financial health should be open now. I've got them out. They're already out there, and they should have. I think. I can't remember. Sometimes they open at 6 o'clock. Sometimes they open at 9 o'clock. They should open tonight, so you can look at them. Okie doke. See you guys next week. Hopefully, I'll be upstairs without my little furry friends. Yes, we love mommy because mommy's going to feed us. Mhm. Okay, I'm going to put him down. Whoa. Okie doke. See you guys next week.
Dr. Goodwin.